Okay, this is the retirement saving challenges for women, and hopefully you're signed into the right location. But when it comes to saving for retirement and planning for retirement, women really face a number of unique challenges when it comes to retirement planning, and we're going to discuss some of those in more detail today. But first of all, women generally live longer than men, and so that basically means that they may have to plan for more years in retirement. And because of their longer life expectancies, women also should consider that they may spend some of their retirement years living on their own. Okay. Um, Women often have to interrupt their careers and take breaks to care for children or even aging parents. And because of these interruptions in their career, women may spend less time in the workforce. Therefore, they potentially earn less money than men in the same age group, which could result in saving less for retirement, but also have a lower Social Security benefit as well. So, these are just a few challenges um, that women may face. And so it's important to recognize them, take a look at each and just plan accordingly. So we're gonna look into a little bit more detail into each one. Statistically speaking, and all other things being equal, women are likely to live longer than a man, their same age. That in itself is not a bad thing, but it means you may need to plan for more years in retirement. So at age 65, a woman can expect to live on average an additional 20.6 years compared with 18 years for a man. Okay. And the bottom line is, don't underestimate the number of years that you may spend in retirement, right? This is just an average of roughly 85 for a life expectancy, which means a lot of you are going to live, to age 90, 95, etc. One thing to consider as well is if you're married, I'll use my situation as an example. I'm 5 years older than my wife, and so if I retire at age 65, and she lives to be 90, our nest egg, might have to last me 20 years, but it would have to last her 30 years if she, outlives me by 5 years. So you got to take into age gaps, take into consideration age gaps in your marriages if that's applicable. So women have a higher likelihood of living on their own in retirement as well. And according to recent statistics, older women are much less likely to be married than older men. Only 46% of women are married compared to 70% of men. In addition to that, 33% of women aged 65 and older are widowed and 16% are divorced. So almost half of all women aged 75 and older live alone. Okay. So for married women, the loss of a spouse could mean a reduction in retirement income from either Social Securities or pensions. So again, just some things to consider there. Women are more likely to take time out of the workforce to raise children and care for aging parents. Sometimes this is by choice, but moving in and out of the workforce has several significant financial implications for women. There can be a loss of income and employer benefits, such as retirement benefits and health insurance. And that loss in income means potentially lower savings. A potentially lower Social Security retirement benefit as a result of that as well. And this is because your benefit is based on the number of years that you've worked and the amount that you've earned. So when you're, jumping in and out of the workforce, it's certainly going to have an impact on Social Security. There's an economic vulnerability in the event of divorce or a spouse's job loss. And possibly, more difficult time finding a job or a comparable job in terms of pay and benefits when ultimately you do re-enter the workforce. So, even women who do remain in the workforce are more likely to request flexible work schedules to meet primary caregiving responsibilities. And, this also can have an impact on their salaries and long-term career advancement. So, these are just a few challenges, that women face when it comes to, moving in and out of the workforce. Generally speaking, women earn less than men. According to Bureau of Labor Statistics, women who work full time earn on average about 82% of what men earn. Okay. This wage gap, again, is going to have an overall effect on Social Security retirement benefits and also on pensions if you're lucky enough to have a pension. It also means women are more vulnerable to unexpected economic obstacles such as job loss, divorce, single parenthood, illness, or the loss of a spouse. So because of these special challenges, planning for retirement is especially important for women. So, where do you start? The first step is to really ask yourself, how much annual retirement income will you need? And it's often stated that you should plan on needing somewhere between 60 and 90% of your pre-retirement income when you retire. And the appeal of this approach is that it's simple. But general guidelines like this, quite honestly, they're not really helpful because they don't take into account your individual circumstances, expectations, or your specific goals. And so it's fine to use a percentage of your current income as a benchmark, but it's more important to focus instead on your current expenses and to really think about how those expenses will change over time as you transition into retirement. So for example, some expenses like a mortgage, the cost of commuting to and from work, they may disappear during retirement, but there's other expenses that might increase. It might be yard care services, snow removal, home maintenance, things you might currently take of yourself, but may not want to or may not be able to do in the future when you're in retirement. You also have to consider how you're going to spend your retirement. If you're going to travel or take up new hobbies, you need to factor in the additional expenses there as well. So when we're looking at retirement planning, I try to break down your expenses and your goals into living expenses, which are, what the money that you have to have just to keep the lights on, right? It's gas, groceries, utilities, property taxes, auto insurance, all that type of stuff. It's the must-have items. And then beyond the living expenses, you have lifestyle expenses, which is more discretionary spending. It can be travel, hobbies, maybe even home improvement projects, things of that nature. And while it may be difficult to try to list all your expenses and project how much you'll be spending in each area when you retire, the more detailed you can be in those expenses, the more detailed you can be when you're doing your own, financial planning and such. Okay. The other thing that you have to account for when you project expenses is inflation. You can't assume that things will cost the same at retirement as they do today. So you have to consider the potential impact of inflation on those expenses over time. And inflation is simply just the rising cost of goods and services, okay? But it's often overlooked from folks when planning for retirement. So unless you take inflation into account, you may underestimate the amount of annual income that you'll need in your retirement years. And you want your income to be growing and increasing year over year as you're in retirement. So if inflation runs at a historical long-term average of about 3% a year, a given sum of money would lose more than half of its purchasing power in a 25-year period. So for example, assuming a 3% inflation rate, a gallon of milk that costs $4 today, might cost $8.38 in 25 years. And all other things being equal, inflation means that you'll need more retirement income each year just to keep pace with the rising cost of goods and services. So to outpace inflation, you should try to have a strategy in place that allows your income stream to grow throughout your retirement years. Okay. The other thing to consider as far as inflation is the inflation rate on healthcare cost is almost double compared to the inflation rate of everything else. Okay. So what you're seeing here is, $50,000 in today's dollars, you would need $104,000 in 25 years just to be able to buy the same stuff that $50,000 buys today. Okay, so that's at a 3% inflation adjustment. Like inflation, taxes are another important part, but often overlooked aspect of retirement income planning. Taxes can certainly eat into your income, significantly reducing the amount that is available to you to spend in retirement. You got to keep in mind when you have accounts like IRA accounts, 401k accounts that are pre-tax dollars, you don't necessarily own all of those balances. The IRS owns a part of those balances, okay? So you want to make sure you understand whether the income you're counting on is or is not subject to tax. So for example, private pensions are generally fully taxable. You might also be surprised to learn that a portion of your Social Security retirement benefits may also be taxable, depending upon your filing status and total annual income. Keep in mind that some income, like interest, is taxed at ordinary income tax rates, while other income, like long-term capital gains and qualifying dividends, they currently benefit from a special generally lower tax rates, okay? And some specific investments like municipal bonds, they'll generate income that can be exempt from both federal tax and sometimes state tax as well, okay? Also understand how distributions from tax advantage accounts like traditional IRAs and 401ks are taxed. Again, generally that money is going to be taxed as income. And regardless of whether the investments within the account are generating long-term capital gains or dividends, it's going to be taxed as income. There are special rules that apply to Roth accounts. Qualified distributions from those accounts, which are funded with after-tax dollars, are generally free from federal income tax. Okay, so you just got to know how your accounts and even your different investments are going to be taxed during your retirement years. Finally, when you're calculating how much retirement income you'll need, one of the most important expenses you need to consider is healthcare. Not only does a longer life expectancy mean more retirement years to plan for, but it also means that you likely will spend more on healthcare for premiums and uninsured expenses. So for a married couple, there's a risk that savings may be depleted by healthcare costs relating to the passing of the first spouse, which would reduce the amount available to the surviving spouse, okay? In addition to general healthcare premiums and expenses, many women will have a need for long-term care because they're more likely to be living on their own in later years. And long-term care basically just refers to the ongoing services and support needed by people suffering from chronic health conditions or disabilities, okay? It's my belief that while a lot of folks that I work with tend to fear market risk, I believe that declining health is probably the greatest risk for people in their retirement years. It's not necessarily market risk. It is hard for us to sort of face the fact that our health might decline, but statistics suggest that about 57% of women will need some type of long-term care services at some point during their lifetimes after the age of 65. And that care can really be expensive. Um, Currently, the nationwide average monthly average for a semi-private room in a nursing home is over $6,800. Okay. But if you don't need the highest level of skilled care, there's other less expensive options, including assisted living facilities, adult daycare centers, and home health aides. But quite honestly, even with those options, you're looking at somewhere between $4,000 to $6,000 a month. So, many people will assume that Medicaid will pay for the long-term care cost. What you've got to realize is that you may be able to rely on Medicaid, but there's a catch. Okay, in order to qualify for Medicaid, your assets and your income must be low enough for you to qualify. Okay, so you have to basically use or spend down most of your savings before you even qualify for Medicaid. And aside from a small personal needs allowance, you'll have to use all of your retirement income, including Social Security and pension payments, to pay for your care before Medicaid pays anything. So another option is to consider long-term care insurance, which may provide for a source of funds for long-term care expenses, but it doesn't ensure that you won't have to pay for some of the cost out of pocket, and the premium for that insurance will need to be factored into your retirement income needs as well. Okay, so there's a lot of factors, when you're calculating your expenses during retirement, there's a lot of things that you've got to factor into that. So now that we've talked about how much annual retirement income you may need, we need to discuss how long that retirement income may need to last. Okay, when it comes to your retirement, how long of a period should you be planning for? So, again, the good news is that we're living longer lives. The bad news is that generally means that your retirement income will need to last for a longer period of time. And as I mentioned earlier, the average 65-year-old woman in the United States can expect to live about another 20 years. Life expectancy has increased at a steady pace over the years, and it's likely to continue increasing. So it's not unreasonable to plan for a retirement that has to last for 25, even 30 years or more, okay? Which means your income and savings will need to last, as long as you do. So there's basically what's called the three-legged stool that really determines where that retirement income will come from. The first is Social Security benefits. Then there's traditional employer pension plans. And then finally, your nest egg, or what you've been able to build up through individual savings and investments. Okay. The first two legs of the stool, Social Security, retirement benefits, and employer pensions, really produce a steady or relatively fixed stream of annual income that you can depend on during your retirement. So we're going to take a look at Social Security real quick. So today, 94% of U.S. workers are covered by Social Security. Social Security is a major source of guaranteed lifetime retirement income for most Americans. For some women, Social Security makes up most, if not all, of the income that they have in their later years. And to qualify for Social Security retirement benefits, you have to work in a job that's covered by Social Security, and you generally need to have earned 40 credits, which is about 10 years of work, okay? If you haven't worked long enough to qualify on your own, you may be able to qualify for spousal benefits based upon your spouse's work record. And a spousal benefit claimed at your full retirement age is generally equal to 50% of the primary earner's benefit. Okay, so there's really two ways that you qualify for Social Security benefits. It's off of your own work record, and it's off of the record of your spouse. Okay, and we'll talk a little bit more about that in just a moment. Like I said, the amount that you'll receive from Social Security is based on the number of years that you've worked and the amount that you've earned. Okay. Your benefit is basically calculated using a formula that takes into account your 35 highest earning years. If you've earned little or nothing in several of those years, it may be to your advantage to work as long as possible, because you may have the opportunity to replace a year of lower earnings with a year of higher earnings, which basically is going to result in higher Social Security benefits. Okay. Another plus is that Social Security's annual cost of living increases are calculated using your initial year's benefit as a base. Okay. So the higher the base, the greater the annual increase will be for you. Okay. Which is something that can certainly help you maintain your standard of living throughout your retirement years, as you're factoring in inflation and Social Security is giving you somewhat of a cost of living adjustment. Now, the age at which you start claiming benefits will also have an impact on the amount that you receive. You can choose to start taking retirement benefits as early as age 62. But if you do, your monthly benefit will be 25 to 30% less than if you had waited until your full retirement age, which is either 66 or 67, depending upon the year that you're born. On the other hand, you will receive a higher monthly benefit if you delay claiming Social Security until age 70. If you wait, your monthly benefit will increase by 8% for each year that you delay taking benefits past your full retirement age. So even if you claim benefits at age 62 and receive a smaller benefit, you'll receive more benefit checks. So for example, if your normal retirement age is 66, opting to receive benefits at age 62 means you'll receive 48 additional monthly benefits. Okay. One of the things that I will often do with clients is use a break-even calculator to forecast the ages when your benefits at 62 would equal your total payout of benefits at ages 66, 67, or 70. And this basically just tells us how long you must live before postponing those benefits would have been more advantageous for you. So again, just the idea of using a Social Security break-even calculator. This next chart basically illustrates what a hypothetical person might receive in Social Security benefits at different ages. And it's based off of a full retirement age of 66, showing $1,800 per month. So as you can see, if that person were to start taking benefits at age 62, they would receive $1,350 a month. But if they wait until age 70, they would receive $2,376 each month, which is almost about $1,000 more. So this monthly benefit is guaranteed every month, for as long as you live, and that's quite a big difference. So the age that you start your Social Security benefits will certainly have an impact on your retirement and the level of income that you're bringing in during your retirement years. Quite honestly, there's no right answer. There's no one size fits all. This is, an individual decision and must be based on many factors, such as other sources of retirement income, your life expectancy, your marital status. So it's not something that you can just paint a wide brush and say everybody should wait till X number of years or X age to start their retirement benefits. Okay. Let's move to the second leg of the three-legged stool, which is basically employer pensions. If you or your spouse is entitled to receive a traditional employer pension, you're lucky. Fewer Americans are covered by such plans at this point. I have heard statistics that say less than 8% of the population is covered by a employer pension plan. And so the fact is, pension plans are decreasing each and every year. Okay. Pension benefits can be complicated, and you want to make sure that you understand how they work and what your options are. A typical pension benefit is payable monthly over the plan participants' lifetimes. Okay, so starting at a normal retirement age, for example, of 65. So this is called a single life annuity, and once the plan participant dies, the benefit payments end. So, even if there's only one payment that has been paid out, that payment, those benefits will stop with the use of a single life annuity. Okay, so it'll pay out for lifetime, whether that lifetime is a matter of months or a matter of 30 or more years. Okay. Now, if you're married, federal law requires that benefits be paid as what's called a qualified joint and survivor annuity, unless both of you and your spouse agree to receive the benefit as a single life annuity or some other form, okay, which would require spousal consent. But basically, the way the QJSA works is that it'll pay a monthly benefit to the participant, and then upon their passing, will continue to pay 50% to 100% of that benefit amount to the surviving spouse. And so it's basically paying out, instead of a single life payout, it's a joint life payout, okay, for both parties' lifetimes. If you're entitled to a pension, your choice of whether to receive the pension benefit as a QJSA or in some other form, maybe one of the most important retirement decisions you make. Okay. And so there's a lot of, you want to make sure that you understand what it is that you're electing for, that you're signing up for. Typically, that decision and those election of benefits are irrevocable. So if you don't understand the options of your pension plans, sit down with someone that can walk you through those options and make sure you're doing the right thing for you and your family. So we're going to take a look at an example, and these numbers are purely for illustration purposes, and they're not meant to reflect the exact benefits that any particular plan may provide. But suppose your spouse retires at age 65, having earned a pension benefit of $4,000 a month paid for his lifetime. Okay, so this would be the single life annuity payout. And because he's married, the pension benefit must be paid as a QJSA unless you both agree to choose the benefit in a different form. Okay, so the QJSA is payable over a longer period of time, both of your lifetimes. The amount paid to your spouse while he's alive would be reduced. And we're going to assume the QJSA, your spouse will receive $3,800 each month. And then after his death, you receive either 50% of that amount at $1,900 a month. And then the other option is, in order to receive 100% of the benefit, your spouse takes a further reduction, is paid out $3,600 a month during his lifetime, but then upon his passing, the surviving spouse would receive that same $3,600 a month after his death. Okay, so that's 100% QJSA. Okay, so it's easy to be tempted to take the single life annuity because it provides the highest monthly benefit, but you got to keep in mind that option would provide no benefit to you once the spouse dies. Okay, so as we've discussed, because women are more likely to survive their husbands, waiving the qualified joint survivor annuity and taking the single life annuity instead may not make sense in most cases. Now, if you have earned a pension as the female, and the statistics show that you might outlive your spouse, it may make more sense to waive the QJSA and then take the larger single life annuity benefit, because again, that benefit's going to pay out for as long as you live, and statistics might say that you're going to outlive your spouse. But again, you've just got to evaluate, those decisions in light of your needs and your plan, because generally those elections are irrevocable. Okay. So we're just going to recap for just a moment. We've talked about how estimating how much income you'll need in retirement. We've talked about how much income you can expect from employer pension plans and Social Security. And if you compare these two, you're likely to find a gap or a shortfall. Unless you're lucky enough to have a very generous pension plan, and you're going to have unmet retirement income needs that generally would need to be funded by the third leg of the retirement income stool. And that's that third leg basically is your own nest egg or your own personal savings and investments that you've been able to accumulate. Okay. So when we talk about your personal savings, we're talking about funds that you have in tax advantaged accounts like IRAs, 401ks, 457 plans, 403b plans, thrift savings plans, and also personal savings. Okay, it might be money that you're keeping in money markets or other brokerage accounts. So statistically, women earn less than men in similar jobs, and they're more likely to work part-time. Women tend to spend fewer years in the workforce, primarily due to caregiving responsibilities. Compounding the problem is that women often start saving later and save less than men, which can reduce their chances of having enough income in retirement. And the combination of these factors means you might not have enough savings in retirement unless you plan properly. Okay, so these factors basically explain why women are at a disadvantage when it comes to saving for retirement, which makes it vital that they take steps to identify and address that projected shortfall. With all the challenges that women face, what can you do? Okay. The first, to state the obvious, is the number one thing is to really start saving now. Set a savings goal that you can work toward and keep track of your progress. Monitor your investments and make changes as needed. Okay. So some of those changes would be as you get closer to retirement and your balances are growing over time. Folks tend to get more conservative as you get older and as your balances grow. Okay. Now, if your employer offers a retirement savings plan, such as a 401k or 403b, and if they match your contribution, start contributing at least up to the matching point. Okay. You want to take advantage of that free money that your employer is giving you through the matching. If you're contributing the maximum amount to your employer retirement plan and you need additional options, or if your employer doesn't offer a retirement plan or doesn't match in your retirement plan, you might consider using an IRA or a Roth IRA. And we'll talk about these in more detail in just a moment. So again, start saving, participate in your employer sponsored plan, and become a knowledgeable investor. Become educated about the different types of vehicles that are out there for you to invest in. Some of you here today may have handled your family's finances all along, while others may be new to the world of investing. But no matter what your level of expertise, there's always room for us to learn more and adjust your plan based upon your current circumstances. And because many women will end up being solely responsible for their own financial well-being at some point in their lives, it's important that you have a sound understanding of the investment world and the options that are available out there. Basically to give you the confidence to make the appropriate decisions for you. Okay. That's where a financial advisor can help guide and direct you into investments that are appropriate for you. And you know, I try to educate my clients as well, not just tell them, you know, what to do, but try to educate them, you know, to the different investment options that are available. So I think that's really important for folks to consider. Okay. This next slide is basically just showing how saving a little extra each month could mean a lot during your retirement years. So here we've got Jane and Sally, who both earn $50,000 a year in their jobs. Jane is saving 5% of her salary each month, and Sally is saving 8% each month. And so you can see that the total monthly savings there is about $208 a month for Jane and $333 a month for Sally. Okay. Now, after 15 years, Jane will have saved over $37,000, and Sally will have saved about $60,000. Okay, which is over $22,000 more. Now, if Jane and Sally both earn 5% a year on their savings or on their investments, Jane's savings would be worth $55,684 in 15 years, and Sally's would be worth over $89,000 in 15 years. Okay, so that's over $33,000 difference just because Sally was saving a little bit more. Okay. So let's talk about some tax advantaged savings vehicles, employer plans and IRAs. Probably the best way to accumulate funds for retirement is to take advantage of these special tax deferred retirement savings accounts. A 401k plan, another employer sponsored retirement plans can be really powerful savings tools because your contributions come out of your salary on a pre-tax basis, which reduces your taxable income and accumulate tax deferred until you withdraw down the road at retirement. Okay. Now, having your contributions deducted directly from your paycheck can make it much easier to sock away money versus saving what you have left at the end of the month. Okay, so it's the idea of paying yourself first. You know, it may be hard initially to receive a smaller paycheck, but paying yourself first should ultimately benefit you in the long run. And many employers will match a portion of the amount that you contribute to your 401k plan. So if your 401k plan does offer a Roth option, you may be able to contribute to the Roth, and what you're doing is you're funding the Roth with after-tax contributions, which don't provide an immediate tax savings, but they allow you to make withdrawals in retirement tax-free of federal income taxes. Okay, so it's the idea of pay me now or pay me later when it comes to tax paying the IRS. Okay, in Roth accounts, you're going ahead and you're paying those taxes now, but you don't pay later. In traditional pre-tax plans, you're not paying taxes now and you're deferring those taxes later on. Finally, 401k plans often include employer matching contributions, which should make them really your first choice in saving for retirement. So if your company offers matching in your 401k, that's the first place that you should be investing in. Okay, you should try to contribute at least enough to receive the full employer match because again, it's essentially free money. Traditional Roth and spousal IRAs can also be used to save for retirement and offer tax advantages. Traditional IRAs like 401ks do give you tax deferred earnings growth and can lower your current income for taxes. And just like 401k, the funds aren't taxed until they're withdrawn later on down the road at retirement. Keep in mind, those vehicles can have a 10% early withdrawal penalty if you are withdrawing from them prior to 59 and a half. And like Roth 401ks, Roth IRAs don't permit tax deductible contributions, but they allow you to make tax-free withdrawals down the road in retirement. So you've got Roth 401ks and Roth IRAs, which are being funded with after-tax dollars. And then you have traditional IRAs and pre-tax 401ks, which are reducing income now and lowering your tax burden immediately. Okay. So how do you, what do you do if you discover that after factoring in your personal savings, your projected income still won't meet your projected expenses in retirement? You know, you're dealing with that shortfall. The best solution for dealing with a shortfall will really depend upon the severity of the deficit. You know, how big is that gap? The length of time remaining before retirement, and how long you need your retirement income to last. But you know, you might consider one of the following 4 options. You either spend less during retirement, you either work longer and delay your retirement date. You could work part-time during retirement, or there might be other, you know, potential sources of retirement income. And we're going to talk briefly about a few of those other options, okay? You know, as you might expect, delaying retirement offers certain advantages when it comes to retirement income planning. The longer you work, the longer you'll be able to continue contributing to your retirement savings. And even if you're no longer adding to your savings, delaying retirement postpones the date when you need to start making withdrawals. And so you're creating a shorter distribution period, which could significantly enhance the potential for your savings to make sure that it lasts throughout your lifetime. As we discussed earlier, delaying retirement may mean that you can postpone claiming Social Security benefits, which would also increase the amount of your annual benefit when you do begin taking those payments. And continued employment may also result in continued access to company health insurance, okay? Now, there may be some advantages if you plan to continue working in some capacity in retirement. The obvious advantage is that you'll be able to earn money and rely less on your retirement savings, leaving more of your savings to potentially grow for the future and helping to stretch your personal savings over your lifetime. Also, full or part-time work during retirement could potentially provide access to affordable health care. If you do work during retirement, you want to make sure that you understand how the income you earn might affect your Social Security benefits. While your earnings may increase your benefit in the future years, current benefits could be reduced. So for example, for the years before you reach your full retirement age, if you are starting those Social Security benefits prior to your full retirement age, $1 in Social Security benefits will generally be withheld for every $2 that you earn over the annual earnings limit, okay? That limit is roughly about, it's over $18,000. So if you're earning more than $18,000 a year and you have started your Social Security benefits early, your benefit will be withheld or reduced, okay? Now, it's worth noting that a number of non-financial reasons may motivate individuals to work in retirement. You know, you may value the social interaction. There's a sense of accomplishment, sense of purpose, there's structure, you know, that your career provides. And ultimately, you know, some folks will launch even a new career or start their own business. Okay, so there's a lot of a lot of benefits to work other than just the financial benefits, okay? One last observation, if you're working for an employer that offers a traditional pension, determine whether working part-time will affect your benefits. If your benefit is based on your final average pay, it's possible that working part-time could reduce your benefit, okay, because your pay is obviously being reduced as well. So it could be worth inquiring about any phased retirement program that your employer might offer. They basically would allow you to receive all or part of your pension benefit while you continue to work on a part-time basis. Finally, think about other potential sources of retirement income that might be available to you. For example, if you have built up substantial home equity, it's possible that you could tap that equity as a source for retirement income, either by selling the home and possibly downsizing, or by borrowing against the value of the home, okay? Another example is existing permanent life insurance policy that has accumulated cash value can sometimes also be used as another source of retirement income. So right now we're going to kind of transition. I want to give you just kind of a glimpse of, this is sort of a little commercial regarding the financial planning tools that we use here at Wright-Patt. I wanted to just kind of show you this 2-minute video about that. For those of you that, aren't going to watch this, once you exit out, there will be a short survey, just about 4 questions. So if you wouldn't mind, go ahead and just, take a couple of minutes to watch the survey. But we're going to go ahead and start with the video that's explaining some of the financial planning that we do here at Wright-Patt.
Life isn't static. Life changes, and it's important to be prepared for those changes. Welcome to Money Guide Pro, the groundbreaking financial planning software that sparks the important planning conversations and helps you create your own personalized plan for your life and retirement. The experience is simple. We start with the easy stuff, your personal information. Then move to the exploration of your personalized goals, which are the heart of a quality financial plan. Your goals are divided into needs, wants, and wishes. Not all goals are equal. This will help us prioritize what is most important to you: buying new cars, paying for college, providing care for a loved one. We'll address each of these and learn what is important to you and why. We also address those items you may not be thinking of. So it's important to include healthcare costs into your goals and discuss longevity to make sure you're protected. Next, we evaluate the resources you have available to fund your goals. We review everything from retirement income, pension and Social Security, to investment assets and insurance, or other assets such as a home, rental property, or business and stock options. Do you have liabilities? We can enter those too, and then view your net worth statement. We'll discuss risk and decide how much risk you're willing to take. You have one question: can I fund all my goals without running out of money? We provide an easy to understand result called the confidence meter, which shows you your probability of success. If you want to see more detail within the result, you can drill down into each individual trial or view a year-by-year breakdown. The plan may not end up in the confidence zone initially, so we'll make recommendations to get your plan into the confidence zone. One of the most interactive tools, the Play Zone, allows you to instantly see how changing some of your expectations, when to retire and how much to save, can impact your plan. We can also test the effects of risks outside of your control. Most importantly, your financial plan isn't static. It will adjust with you over time, and we will continue to review and make improvements as your life changes. You'll be able to view your plan through easy online access. and see your dreams come into reality.
All right, you guys, that basically concludes the presentation for today. I don't see any particular questions in the chat. Here is my contact information. And so if you do have any questions, or if you would like a follow-up call, or want to reach out to me, here's my contact information if we can be of help to you. But that concludes our presentation today. Thank you.